good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, Christmas may be over, but it's never too late or it's never a bad time to give yourself a gift. And today, what better gift can we give ourselves than the gift of financial security or financial certainty in the future? So today we're going to take a look, we're changing gears a bit and turning away from earnings reports, and we're talking about objectives overall. And how can you, or myself, or all of us, give ourselves that gift of financial certainty? Well, certainly, like in all other endeavors, time is your ally. And we take a look today at two examples of two persons, Renata and Nigel, in their journey towards their financial security objective of getting a target value at a retirement age of 60 years of $1 million. And they're going to do this with an expected annual return on their investment over their differing time periods of around 4.5%. Now, the key difference between Renata and Nigel is not in their return expectations, is not in their retirement age or the amount that they want at retirement, but it is their time horizon. Renata has decided to start off at quite an early age of 25 years. Nigel has started a little later. He's possibly a late bloomer in terms of investment awareness and is starting at the age of 50. So that gives Renata a time horizon, or investment time horizon of around 35 years, whereas Nigel just has 10 years until he reaches his target retirement age. Now, there are some key things in terms of investments and how time is quite a powerful tool in achieving your investment objectives. And the first is that having an earlier start means that you have to set aside smaller contributions or invest a smaller proportion of your overall income on a monthly basis, albeit for a longer period of time, to achieve your investment objectives. In the case of Renata, with 35 years to go, she would have to set aside just around $983 a month, which compares quite favorably to Nigel, with just 10 years to invest to get to his $1 million target, having to set aside a whopping $6,600, just over $6,600 a month, to achieve his target under the assumptions provided. So Renata might be investing for 25 more years, but she is investing on a monthly basis just about 1/6 of what Nigel would be contributing or investing on a periodic basis or a monthly basis to achieve his financial objectives. Now, how does that translate into their $1 million target? Well, while Renata would have to contribute for a much longer time, that's the 35 years, overall, out of pocket, Renata would be contributing just around $413,000, or roughly half of what Nigel has contributed, which would be over that 10-year period, $794,000, or 80% of his $1 million value. And the key difference between Renata and Nigel is the benefits of the power of compounding of their returns on investments, where at a 4.5% return annually, Renata's return would account for just around 60% of her total $1 million target, meaning that her money works for her for a much longer period of time, and those benefits are much more significant. Nigel, on the other hand, just over his 10-year period, would generate just around 20% of that $1 million target, or $206,000 in investment return. So certainly he would have had to contribute much more in terms of monthly contributions, and it would have had a shorter period of time to work for him. So again, the benefit of investing is really the earlier you start is the greater it becomes. Now, you might have the time, but you don't necessarily need to have the skill to achieve your financial objectives or your investment objectives. There are many investment vehicles or investment solutions which help you get there, and one of those particular types of investment vehicles or investment solutions with a long-term view of investing would be a retirement fund. And some of the key advantages of retirement funds would include their professional management. So they are monitored on a daily basis, and investment actions, decisions, etc. are taken on a daily basis by qualified professionals. Retirement funds take a much longer term view of investing, so it aligns well to those persons looking to secure their financial tomorrows. There is a significant amount of built-in diversification. So these portfolios are quite diversified, comprising many stocks and different bonds. And these allocations will change over time based on how your investment manager or professionals would see the market evolving. There are quite significant tax advantages where you can create a $50,000 tax shield per annum on your contributions to retirement funds. And most importantly, you don't have to be a Warren Buffett or other famous investor to make your investment objectives or goals or wishes a reality. It's a very convenient and hassle-free solution. You pretty much just set it with a provider that you are comfortable with, and you can almost forget it over time as your returns will stack up. Now, That 4.5%, is that realistic? Well, we take a look at the SAVINVEST Individual Retirement Fund, which is managed by Bourse. And this is a particularly good, rewarding retirement fund. And over the past 10 years, from 2010 to year to date, that $100,000 invested in this particular fund would now be worth just under $170,000. As we can see, that red line has had generally an upward sloping movement, and that translates into a return of 5.4% per annum. So ahead of the target return in our example of Renata and Nigel. And we can see that there's no sure thing in investment. Those returns would vary over time, but generally with a long-term view, you tend to get a reasonably good performance. And that brings us to our third and most important, one of the equally important factors of investing earlier, that you can navigate multiple investment cycles. So just to wrap up, the benefits of investing are significant if you want to give yourself that gift of financial security, yourselves and your families. Investing earlier has three particular key advantages. One, smaller monthly contributions, meaning it's less of a burden on your pocket today, so it doesn't impact your lifestyle as much the earlier you start. It has the potential for greater investment benefits and the power of compounding over time. And again, you can navigate multiple investment cycles over the long run. Well, that's it for this week's edition. For more information, you can give us a call at 2BORSE or 226-8773. Email us at invest@boursefinancial.com or check out our website, bourseinvestment.com, for all of our research absolutely free. And of course, you can catch us in today's business section of the Bigger, Better Trinidad Guardian. Until next week, have yourselves a great investing period. This has been the Bourse Report.